Are you ready to try your hand at placing your very first stock trade? Then check out our free guide, 10 Steps to Choosing Your First Stock to Trade, the Ultimate Beginner's Guide. In this free download, you'll learn how to choose the right kinds of stocks and how to find them, know when to buy your stocks and when to sell them, and you'll learn how to take your very first steps to becoming a stock trader and much more. Grab your free guide now by going to TRADEway.com/guide. That's TRADEway.com/guide. Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hello, everyone. Welcome back to our podcast. Hey, today I want to talk about how the Fed moves the market. Or better, maybe we should say how the Fed manipulates the market, right? In the old days, we could have even had a subtitle like this. We could have said, for example, are bear markets created by the Fed? Well, now we would have to change that to bull and bear markets being created by the Fed. So it's really pretty amazing. Now, when we talk about these things, it's really might surprise some of you guys because you probably think that bull markets and bear markets just sort of happen because of supply and demand and different issues going on in our country and around the world, when in reality, the Fed causes it. So let's take a look at that. Back in 2009, when President Obama was president, we had just had the Great Recession, which, as you know, happened in 2008. And in order to try to pull our country out of that, Obama and his people began a huge quantitative easing campaign. Now, that was quite a long time ago, but what is quantitative easing in case we don't know? Well, quantitative easing, the easiest way to think about it is the government printing money. Now, it's not that simple, but the effect is as if they had just printed billions of dollars. And so they did this time and time again, about 4 times a year. Now, this lasted about 8 years. And so what happened during this time period was the stock market just went up and up and up. It was like giving candy to a kid, you know. The market loves when the money supply grows. And so you could say that for the first time in history, the Federal Reserve of the United States actually created a bull market. Now, what's interesting about that to me, because I've been trading for 40 years. So maybe I'm the oldest guy you can read about on Google. I don't know about how to do stock trading, how to do support and resistance lines and all those things. But what I do know is, in my recollection of all those years, all the Fed did was murder bull markets, not create them. And then all of a sudden with President Obama, this changed. So I guess you could say he was innovative in this area because he figured out how to get the Fed to create a bull, which made him look like a better president from an economics point of view. So the government stopped printing money out in around 2014. And then in 2017, they finally started lowering their balance sheet. Now, all of that, I don't even go into how they print the money and how their balance sheet has to do with it right now. That's beyond the scope of this show. But anyway, let's just say they stopped printing money. All right, well, what's interesting, in 2022, all of a sudden we started having major problems with inflation. Some of that was due to COVID and the supply chains being all messed up. So the government started paying attention to it in 2022, but you probably noticed it before that. During COVID, you just couldn't get things. They didn't show up on the shelf, and then when you did, they were way pricier. So this has really been a problem that's been growing, and now it's to the place where the federal government has noticed it and big time, and the Fed is going to stop it no matter what happens. Well, let me tell you what happens is it kills the bull market, right? So we're going to take a look at this in history, and I think it'll be a real eye-opener for you guys. So there was an article back in July 26th of 2013. It was called, "Can the Fed Prevent the Next Recession?" And it's kind of funny when you think about it. That article was in Seeking Alpha, which is a pretty good website. But, you know, that's kind of interesting because That's really what they're trying to do right now, isn't it? So now we find ourselves in 2022. We could ask the same question: can the Fed prevent the next recession? Well, the problem is the Fed cannot prevent it this time because they're not trying to prevent the next recession. They're trying to stop the inflation. You can't do both at the same time. And that's, they're not telling the world that, but if you know anything about economics, you know they cannot do both at the same time. So in this article, it says this: researchers tend to agree that the Federal Reserve has controlled the end of every bull market, as shown by numerous studies that link inverted yield curves with economic contractions. But does the history of the business cycle and monetary policy in the decades prior to the Great Recession, that's 2008, 2009, does it still resonate today? In other words, does it still work that way? And the implied answer in this article was yes, it does. The Fed still knows how to kill bull markets. The article says they killed every bull market in history. And I've got an interesting chart here that proves it. Of course, you can't see the chart, but I'm going to talk you through it here in a minute. But they do control these things, and a lot of people don't realize that. Now, in this article, an MIT professor was quoted, and he said this in 1997, quote, "None of the U.S. expansions of the past 40 years died in bed of old age. Everyone was murdered by the Federal Reserve." Now, that's an interesting quote, isn't it? So we see from the facts that in the past, the Fed predominantly ended bull markets by artificially raising interest rates. And this is seen in the following chart, but you can't see the chart, but it's very interesting. This particular chart is a rolling 12-month percent change in real monetary base of the U.S. dollar, right? I found this at capitalspector.com, and it comes from the St. Louis Federal Reserve. They put this chart out. But what it shows is it shows every time where the Federal Reserve began to cut the money supply. Now, how do they cut the money supply? Well, they stopped printing money if they had been, and they began to raise the interest rates. Now, why does that affect the money supply? Well, if you take economics, you'll understand that the way money is created normally is it's not actually always printed, but what can happen is if you do things to cause more and more people to use debt, for example, by lowering the interest rates, then more and more people will borrow money. And when people borrow money, it actually adds money to the money supply. And so that's what we mean when we talk about printing money. The government just makes it where more and more people want to borrow money to buy houses, to buy cars, to buy furniture, to buy everything. And as they borrow all this money, it adds more and more money to the money supply. Well, when you add money to the money supply, it causes the stock market to take off. It's like I said, it's like candy to a child. It loves it. And, all of a sudden interest rates are low and they're driven down by the Fed. They control the interest rates. And as they lower those interest rates, all of a sudden the money supply grows and grows and grows. So all they have to do if they want to kill a bull market is to begin to raise the interest rates. That way, fewer people want to borrow money, and all of a sudden, the money supply contracts. And it works every time. If you could see this chart, there's a little gray bar that goes down every time they began to cut the money supply. And you can see that there are little gray vertical lines on this chart that show where recessions happened. And there's a little line going horizontally across there that shows the money supply going up and down. And every time you see a gray bar indicating a recession, right before it, you can see that money supply chart was tanking. They were lowering the money supply, and then you had a recession. It happens 1, 2, 3, 4, 5, 6, 7, 8 times there on this chart between June of 1963 and June of 2013. So that's a pretty cool chart that it just demonstrates the very fact that they can control when recessions happen by controlling how they deal with the money supply. So if they want to kill a bull market, then they just raise the interest rates, and that lowers the money supply. Now you say, why would they want to kill a bull market? Well, because they hate inflation. They don't hate it enough in my book. I really think governments actually like inflation. In fact, the Fed, their goal is to have inflation just slightly above 2%. And you say, why would they want that? Because that weakens the dollar, and it means that every year that I live, my dollar will buy less and less stuff. Well, they just have a theory. Modern monetary theory says that a little bit of inflation is good for an economy. It'll make it grow, and they want the president to look good. They want the government to look good. So they want to keep it growing a little bit above 2%. But what happens if it jumps up to 4%? Or you go like in the Jimmy Carter years where it was like, what, 9%? Well, they don't like it getting that high. So what they'll do at that point, they will start to raise the interest rates. And their goal really is to cut the inflation, not to kill the bull market, but it will kill the bull market on U.S. stocks every time. And that chart we just looked at proves it. Now, what's interesting, as I said, with President Obama, the whole idea changed because up until that time, all they had ever done was kill bull markets by raising interest rates so that they could stop inflation or cool it off. And but with Obama, when we had the Great Recession right before his term, or right during it, I guess, when he first was elected, he chose to try to get the Fed. Now, I know they're supposed to be independent, but yeah, read between the lines. Things happen under the table, don't they? So anyway, what happened was he convinced the Fed, in my opinion, to begin to lower interest rates by printing money. In other words, increasing huge amounts of money to be borrowed, even by increasing the government's assets, which what that does is it pulls bonds off the market. So the supply is smaller, so the price has to move up. And the interest rate is inversely proportional. So the interest rates move down. And as those interest rates moved down, it created perhaps the longest bull market in history. So now we bring ourselves to today, right? 2022. And here we see inflation is really heating up. It's making the government really nervous. President Biden is sort of in trouble with midterm elections because they're getting blamed for a bad economy and for inflation. People are having to pay so much for everything. They're angry at the government, right? So what are they doing? They're trying to get the Fed to increase the interest rates. And they've done it twice already this year by 75 points or 0.75 of 1%. But that is a huge move, and they've done it twice. And so now the stock market is beginning to see this, and we found ourselves in a bear market. So now we've been in a bear market for quite a number of months. And there's been a little pullback up here, but that's pretty normal. It doesn't mean that the bear market's over. Many, many people out there, including myself, I would have to say, my guess is it's not over. It's already made sort of a double bottom, but I think those are just attempted rallies. And I think that as we see the earnings reports continue right now in this quarter, they just started firing up now, and you see the news. You see the inflation starting to really hurt things more and more. I think you're going to see this bear market continue for a while. It may or may not. You can't predict it, but it probably will continue for a while. So what did the Fed do? Well, they started raising those interest rates, and sure enough, they killed the longest lasting bull market in history, and now we're in a bear market. So you can take it right back to when they did the very first increase, pretty large increase of the interest rates. And then when they did the second one, now we see we're in a bear market. So with that in mind, now that we know that the Fed controls these things, how can that affect our trading? Well, it's kind of good, because when you have knowledge like that, it gives you at least some bit of predictability, right? I mean, when we saw the Fed start to raise rates, we knew that eventually it would kill the bull market this past year, and it did. Now, we couldn't give the exact date, but we could watch charts and we could estimate the date pretty well. And just knowing that they're raising the rates helped us to believe in our predictions a little bit better. So it actually helps in creating some predictability, which helps us know what kind of plays to do. So think about it. If you knew a bear market was coming, you might want to go out to TRADEway.com, take advantage of some of the educational programs there, and learn how to buy puts, because when you buy puts, it gives you potential to make money when the market is moving down. Now, your neighbor doesn't know how to do that, so he calls it a bad market when it's a bear. You'll learn that a bear market is not a bad market. It actually gives more potential to make money faster than a bull market, because puts make money faster on average than call options do. And so it can be a good thing for your family if you learn those strategies. I'd run out there to TRADEway.com and get involved very quickly with some of those beginner courses. The second course we teach teaches how to do puts. And that's what you need to know right now, I think. So think about this. If you know the mind of the Fed, that is a key in your stock trading strategies. Kind of learn what the Fed is thinking and what they're doing and what they're about to do, and learn how to read news on what the Fed's doing. That is a really beginner notion to really help your stock trading, and your neighbor really doesn't even know about it. He doesn't think the Fed affects it, but the Fed causes these big up and down moves. What I would do when you get into a market like we're in now, where it always wants to be a bull, but right now it just can't be because it's very bearish because they're raising the interest rates. And so I would suggest make your stock plays shorter, whether you're doing stocks or options. And especially if it's put plays, they're generally shorter anyway. They might last 2 or 3 days, whereas a call option play when the market's moving up might be more like 2 weeks. These plays should be shorter. So first thing I would do when you find yourself in a market that's being hurt by the Fed is I would make the plays a little bit shorter, maybe 2 to 3 days on these put plays. Now, there are some strategies that we teach. Some of them are advanced strategies out there at TRADEway.com. There's one called News Moves. It's kind of cool because it'll teach you some newsy plays that last only 1 to 2 days. And that's pretty ideal for markets like this. And we've got one called Stock Flippers, which is pretty cool, kind of like house flippers, right? Only it's with stocks. And it has to do with covered call writing. And covered call writing is one of the safest strategies you can do. And it's great to learn that. In step 3 and step 4, we have credit spreads and debit spreads. Those types of plays can be very short. They can last anywhere from 1, 2, 3 days to 5 days. And so those types of strategies are really good for doing shorter plays, which I think are important to know how to do when the market's being damaged by the government like it is right now. So another thing is during times like this, the emotions of the market change more often. So it gets more volatile. Wall Street tries to control these things by whispering little, quote, news items into the ears of young correspondents who need stories. And a lot of times they're feeding these stories on purpose to get the market to do a certain thing. And so sometimes they'll kind of take bad news and twist it a little and make it sound like not such bad news. In other words, they turn it into good news. And the way that they present these news items, it can make the market move up for a couple of days when you're thinking it should really be moving down. So you have to really watch these emotional changes in the market due to the news items, and it really helps if you can learn what kind of news is real, what kind of news is junk news, and that's the hardest thing to learn, I think, in stock trading, but we're going to help you with that. Almost every program you find at TRADEway.com, we're going to include market alerts with that, where we help you with that market tone to know which ones are real and what news you should be watching for. So the emotions of the market change more often, so your plays need to be shorter. So you need strategies that don't take very long to get in and out of in order to make your money. Often these bear markets happen in the 4th or 5th year of a bull market when it starts to become old and tired and all the stocks are driven up so high, and all of a sudden, you find yourself in a major correction or a bearish move down. And so, about the 5th year of a bull market, it's time to start watching for these things. And during times like this, you're going to have some up days and dark days. All of it's because they're trying to move the emotions around just to cause people to come in and buy the stocks even in a bear market. And you really have to watch that and know that that's what they're trying to do with that news. During a session of dark days, what you want to do is find those and do down plays like buying puts. Or you could do a thing called a bear put spread. Now, that's a debit spread. We teach that in step 4. They can last anywhere from a day to 2 days, and you can be out of the market. Now, on happy days when they're floating positive news, you could do a bull call spread. It's very short. You can be out of that in a day or 2. So there are a lot of strategies out there that can be really good for these shorter types of moves. News moves is one of my favorite. That's one of our advanced strategies, but to be honest, you only have to be through about 2 of our steps, which means you need to learn how to buy stocks, and then you need to learn how to do call and put options. And once you know that, you could do news moves, even though it's an advanced strategy, but it can be really helpful in times like this. And another thing you watch for is, Usually after a major correction, it's going to try an attempted pullback. So you might have 3 or 4 or 5 days to a week or two where the market actually moves up if you like up plays better. So even in a tired old market or a bear market, you will have these retracements which move in the opposite direction, which means up in a bear market. So they'll move up and give you a few days for some up plays. But I think the best thing is let it move up, hit some type of moving average that it likes to hit and bounce back down, and then start looking at puts again. So this is kind of how you treat these types of markets. Your neighbor just calls it a bad market. Actually, there's some really great opportunities when you have these skill sets. Now, sometimes in these types of markets, the market just moves sideways for long periods of time. I remember the last 2 years of President Obama's reign, the market just moved sideways. It made no headway either up or down. So there are even strategies that will make money when the market doesn't move at all. And those are called credit spreads. We teach those in step 3. So you can get out there to TRADEway.com, take advantage of this great education. Remember, with every one of these strategies, you want to do this. You want to paper trade them first where you're not using any money. Then you want to small money trade them where you use a very small amount of money, but you learn whether you're doing them right or not. And then later you can start putting the money you want to put into these trades. Another thing you can do in markets like this is you need to be aware of late stage bases. If you see the market trying to recover and move up, and let's say a stock makes 4 or 5 flag patterns moving up, well, when you get to that 5th one, you're at what we call a late stage base. It's not as likely to keep working as it had been on those particular stair steps or flags. So all of those kinds of things, these cool little patterns, are covered in our educational material, and it's time to get started on it now. Now, you may say, well, I don't know if I want to trade in a market like this where it's just all over the place. Well, guess what? The best trading you will ever have is in the first year of the next bull market. And they always show up. After every bear, you're going to see a bull. So right now, while this market is kind of moving up and down and deciding what it's going to do, you've got a little bit of time to jump in there and get some education done and some paper trading and small money trading so that you're ready to go. You got your trading accounts open and everything, and you're ready to go when that next bull market starts. Okay, but if you're already trading in a time like this, I got one more bit of advice for you. What you'll find is after these big moves down, it will try to recover and move up for a week or two sometimes, and you can get one good trade done. Like you could do a call option play, but here's the problem. You make money on that, right? And you say, oh, well, I'm going to jump in and find another one. I wouldn't do that. I would just be happy with that money that you just made and let it go ahead, because it's probably going to turn right around and head down again, and let it do that. And then when you see the next opportunity, find one good trade. And don't try to back that up with a second and a third great trade and make more money, because if you get a little bit too greedy in a market like this, you're going to give the money back to Wall Street. So you got to watch that. So remember, calls may not work that great, but they can work after these big moves down for just a few days. But better than that, maybe you better get good at puts. And there is one other great pattern you can learn out there. Sounds kind of funny, but it's called a kiss goodbye. Those probably statistically have the best results of anything I've ever seen, but I can't explain it over this podcast. You just need to go out to TRADEway.com, get involved in the education, and find that pattern called the kiss goodbye and master it, because right now in these kinds of markets, that is a really good one. So you have a few opportunities to trade. I would catch every kiss goodbye that you find. That's this particular pattern that is made out there in markets like this. And you have to be decisive. You've got to anticipate moves with the kiss goodbye, but we'll teach you how to do that. So there's another great strategy you can learn out there at TRADEway.com that'll help you with markets like this where your neighbor he's just throwing up his hands and he's losing money because probably his financial advisor's leaving his money in all the way to the bottom of this stupid thing. And at least you can learn to go to cash, right? You can call your financial advisor and say, hey, dude, go to cash. I don't want to be in this market. That's with your long-term money. And then you can take your 5, 10, 20% of your money that you're trading with, and you can do these kinds of trades we've talked about today and get in and get out, though. You don't stay in long, and you still have potential to make money even in a bear market like this. All right, well, I hope you enjoyed this show today, and if you did, would you please rate and review it? That way other people with similar interests can find us. That'll be a help to them. We really appreciate that. Hope you have a great day, and we will see you next time.